For example, the Social Security Investment Fund has embraced sustainability. The fund issues annual sustainability reports and have committed to take steps towards adopting the principles and objectives of ESG within its investment. My understanding as well is that most of the banks, they have complied last year to the ESG reporting. Furthermore, the Amman Stock Exchange signed a joint agreement with the IFC, which aims to provide support and training to the employees of the stock exchange and the companies listed in it, to enhance their knowledge and awareness of ESG standards, as well as supporting the development of the Climate Disclosure Guide with the Amman Stock Exchange to serve as a guide for implementation by listed companies. And also my understanding is by the end of this year, all companies listed in Amman stock market will be obliged to report their ESG, on their ESG. We wanted to learn more about what JSF members are doing with regards to ESG. So in the registration form, we had a short poll about our members' efforts with regards to ESG. Allow me to quickly share the results. When we asked about companies' awareness of the environmental, social, and governance framework, 81% said that they are aware. When we asked if the companies created and implemented an ESG strategy, 44 said yes, and 33 said they are in the process. Also, 68% of the companies said they released an ESG report. When asked, what is stopping you from creating and implementing an ESG strategy, the main response was that they did not understand how to implement ESG if they are in the service industry or do not produce carbon emissions. When asked what were some obstacles your company faced when creating and implementing your ESG strategy, some of them responded that there was lack of awareness and acceptance, lack of data or inability to collect the data, lack of resources and clear definitions and guidelines, and poor understanding of relevant legislation in Jordan. Lastly, when asked what is stopping your company from releasing ESG reports, the main response was not having full awareness of what an ESG report is and what it entails, as well as lack of expertise in collecting the data needed. This is all proof of great efforts and interest in ESG, and we must keep building on this. Jordan has committed to lowering our nationally determined contribution by 31%, as well as committed to improve Jordan's ranking in the Global Environmental Performance Index and in the Global Sustainability Competitiveness Index. None of these goals could be achieved if the private sector does not work towards sustainability themselves, and we are gathered here today as a first step to build powerful momentum from the private sector jointly with the government towards sustainability. Before giving the floor to our guest speaker, Jason Channel, who is the Managing Director and Head of Sustainability at City Insights, allow me to remind you all that ESG involves three components: environment, social, and governance. Mr. Channel will deal mainly with the environmental component of ESG and some of its metrics. Mr. Jason previously built and led City Sustainable and Responsible Investment Research Team from within City Research for #1 ranking around the world in the Institutional Investor Survey. Throughout his career, Jason's research has covered many sectors, spanning the energy spectrum of utilities, oil and gas, and alternative energy, and has been highly ranked in many sectors. Jason started his career at Fidelity Investments, and prior to joining Citi in 2011, worked for Goldman Sachs, where he built and led the alternative energy and clean tech coverage globally in equity research. In addition to his extensive exposure to institutional investors and corporates, Jason's broad knowledge base has led him to present to countless governments, policymakers, supranationals, and regulators around the world on energy policy and sustainability. At this point, I would like to give the floor to Jason. Thank you.
Well, thank you so much for that kind introduction. And Excellencies, honoured delegates, it's a pleasure and an honour to be asked to speak to you here today. It is, as we heard, it's a fascinating area, but it is such a broad area, sustainability, and that often can be the biggest challenge with it. And it's also one of my challenges for speeches like today, where you have a room of people at very different stages of journeys across very different industries who will be facing different challenges about how we address this. So what I'm going to try to do is to set the scene, really, and to give you some topics to think about. And then I know we're going to have more of a discussion later on, and I'm sure we can cover a lot of the topics that I will inevitably miss out on that route. So the first thing that I was asked to speak about today was just what is ESG and how do you do it, right? Which is a pretty simple question, but a pretty fundamental one. I think the first message that I want to give you is that this isn't anything new, and this isn't anything that you haven't done before by a different name, right? It might look and feel different, but really all it is risk and opportunity by any other name.
Can you put slideshow?
I'll come to that a bit later. Yeah, it'll probably confuse people if we put. I'm going to speak generally for a bit, but thank you. So it's just risk and opportunity by any other name. So when you look at ESG frameworks, you get these enormous lists of factors that you should be thinking about, and part of the problem with that approach is that you can unwittingly end up going down very much a box ticking route, right? Of going, well, I've done that one, and you're not really thinking about what this is supposed to be about. It really is just risk and opportunity, and the key word, if there's one word you take away from today, let that be materiality. And that is when we look at, so when you used to get the old versions of ESG scores that were applied to companies, some of those scores would be made up of about 200 different metrics in terms of, do you have a policy on this, do you have a policy on that, etc. Now, the reality is for the majority of businesses, there's going to be 4 or 5 things that really matter to that business, right? So if it's a utility, it's a pretty safe bet that it's going to be carbon emissions. But do I really care about the carbon emissions of a media company? It's not that it doesn't matter, but it's not the biggest issue, is it? And so on and so forth for many different businesses. So the key to this is focusing on materiality. And when people say, how do I start doing this? It isn't about going onto the website, getting the framework, starting to go down the list, filling the boxes in, because if you do that, you'll completely miss the point. What I always suggest to corporates that they do is actually take some time out and step back from all of this and ask some pretty fundamental questions. And a lot of CEOs say that after they've done it, that it was an enormously cathartic experience. And where we always tell people to start is by actually thinking about what your business exists to do. Now, I know that might sound like a bizarre thing to do, and everyone thinks, well, we take that and we turn it into that and we sell it and we make money out of it, right? That's not actually what your business exists to do. Every business exists to meet a need in society. So if it didn't, it wouldn't exist, right? So actually stepping back and thinking, why does the business exist? What does it exist to do? Now, making money is a very important byproduct of doing that, because if it doesn't make money, the business won't continue to exist. But why does it? Why does the business exist? What is it? What is its purpose? And then I think once you sort of have that sense of where you are and what you do, and I know that sounds stupid, but you'll find an awful lot of businesses come up with slightly different answers having thought about it than what they thought it was. You can start to look at your business and say, right, what am I really proud of in this business? What do I like telling people about in this business? But also, equally important, what is the part of my business that I am terrified about of getting in the newspaper, or that photograph appearing, on social media of something at the end of a supply chain or whatever? And every business has them. And if you tell me you don't have something like that, I don't believe you, because every business does, right? And these are the things to start thinking about, right? Start thinking about how your business impacts the environment, but also how does it rely on the environment. I love one of the responses up there. My business doesn't produce any carbon emissions. It's just simply not possible, right? So you can say, well, actually, we're just an assembly business. We don't use furnaces. We don't manufacture anything. Everything that goes into those components, which is being assembly, all the materials that come out of the ground, and we're going to come back to this later when we start talking about Scope 3 emissions. Every business, whether it's its own operations or its supply chains, etc., has an impact on the environment. And you also have to think about the impact of the product that you produce. So we could turn around as a bank and go, right, well, we've got a few carbon emissions because they come out of our buildings, but actually, it's not really much compared to utilities, so we don't need to think about that. That's not the point. The point about the impact that our business has, and more than 90% of our Scope 3 emissions comes from what we call financed emissions. So obviously the impact that we have is, what do we finance? What do we facilitate? Right? So if you look at it from that perspective, our Scope 3 emissions are enormous. Right? So if we ran around the world financing every coal plant and we didn't do anything in alternative energy, our Scope 3 emissions would be enormous. So it's not quite as simple as people might think. And that's why, you might be sitting there thinking, I don't have time to sit down and take a step back from my business, but that's why you have to sit down and think about your business and think about those impacts. Is it supply chains? Is it raw materials, etc.? So think about that, not just from an environmental perspective in terms of how you impact society, the environment, how you rely on the environment, but the same for social as well. What impact do you have in society? Now, presumably, you all have some form of positive impact on society, otherwise people wouldn't be buying your product, right? Even if that goes further down a supply chain, it's exactly the same from a service perspective. But how do you rely on society as well? What are the bits that you're dependent on there? And I think that starts to give you a picture of your business. Then what you can do is you can take those frameworks and you can go, right, now that I have a picture of who I am, I'm going to apply that framework to my business. Not, I'm going to take my business and wedge it into that framework and tick some boxes and put a report out. Because if you do that, you'll sort of keep the wolf from the door, so to speak, and people will be broadly happy, but you're not actually going to change anything, and you're certainly not going to be viewed as a leader. So why should you do all of this? The benefits of doing this was one of the other things that I was asked to touch on today. And it really comes back to what I was saying about risk and opportunity. If you're focusing correctly on materiality, these are risks to your business, right? So this could be environmental risks, and that could take the form of physical risks. It could take the form of reduced water. It could take the form of flooding, etc. But it's also transition risks as well. So if it's your classic analogy of the horse salesman at the turn of the last century, who looked at these newfangled automobiles that were driving down the street and said, well, that'll never catch on, right? What are the risks that are coming from those transitions all around you that are happening in these other businesses in the business ecosystem, and not just here, but also around the world, because that will affect via supply chains and via global trade, all of these things. At the same time as there is risk, there is massive opportunity, because all these things that are disappearing There's going to be whole new industries which are going to pop up to substitute those industries which are disappearing, which will require new raw materials, new skills, new services, etc. And we're seeing for many businesses around the world. One of the most fascinating conversations I had recently was when we were talking about the circular economy and the impact that has on businesses. We were speaking to a very large global auto manufacturer who is looking at how you can make an auto manufacturer circular. And they said the only way we can make the business circular and guarantee to deal with the vehicle at the end of its life, to get it back at the end of its life, the only way we can guarantee that is not selling it in the first place. So they're now looking at effectively this concept of mobility as a service, where you don't sell the car, you effectively lease the car. And then you can change components, and it particularly works well with electric vehicles where you're replacing batteries and conceivably they own the batteries and they manage the batteries, and then they can be discharging when you park to get your groceries and arbitrage on electricity networks. So all of a sudden you're having a conversation with an auto manufacturer who is looking at this going, right, well, that completely changes my business model. For decades, I have been a company that wants to manufacture the best product I can at the lowest cost I can and sell as many of these as I possibly can. All of a sudden you have a hotel or an airline type business model where you're worried about utilization, and your balance sheet looks entirely different because it's not about capital investment. It's all about working capital. It's about lease finance, etc. So the reason I mention that is that's, you'd look at an auto company and you'd go, right, well, yeah, that's going to be about emissions, etc., etc. But when you start thinking about this and the other aspects of sustainability and environmental impacts, you'd think I'd be better at that word, wouldn't you? The number of times I say it, but you think more broadly about the impact on a business model. It can be about very, 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 very different things. So it is about risk, but also about opportunities, because if they get that right, they have the opportunity to turn into an entirely different type of business, which can grow. And if there's other businesses that aren't doing that, who then end up getting taxed on waste, then clearly they're not going to be in such a strong position. The other aspect to this is, of course, financing, as we heard earlier. Now, you saw some very big numbers earlier of the 41 trillion and the 50 trillion. The sky is the limit on these numbers. If you want to look at the signatories of the PRI, which is the Principles of Responsible Investment, so that's asset owners and asset managers who've committed to incorporating environmental and social and governance decisions, factors within their investment decisions. Their assets under management are now over $100 trillion. If you look at the assets under management of the people that signed up to GFANZ, which is the Glasgow Financial Alliance for Net Zero, that's 133 trillion. So 1 year's global GDP is about 85 or 90 trillion, right? And if you take out all the financial assets in the world, you're talking about a couple of hundred trillion, right? So don't be under any illusion that this is a niche part of the market. Now, this is absolutely the mainstream. There's bits of it that aren't doing it, and there's regions of the world that are slower, but they are going to get fewer and fewer, and smaller and smaller, and that will disappear. And what it means is that, and it comes back to this point about risk and opportunity. If you're doing this right, and you're focusing on materiality, and you are reducing your risk, that should give you a lower cost of capital, right? Now, sometimes it's difficult to prove that, but we do have many examples of where that's happening, about differential pricing historically on green bonds, on social bonds, on sustainable bonds, etc. And we're also seeing it with supply chain finance as well, where companies are encouraging supply chains to help them meet their own targets, and they're offering more attractive trade finance terms to companies which are in line with them or ahead of them on their goals. And they're also, by the same token, penalising companies that are behind them. And I have a slide to show you on that in a second. So it really is. I hate it when people talk about non-financial reporting and things like that, because this isn't non-financial, right? I mean, at worst, you could call it pre-financial reporting, but all of this stuff eventually finds its way into the P&L, into the balance sheet, and into the cash flow, whether that's through consumer preferences and the propensity to buy the product, or the pricing of that product, or your sourcing costs, and ultimately in terms of taxation and regulation, etc. So these things are not non-financial. You'll often see them referred to like that. So the same is true that in the same way you can get cheaper financing not doing this. If the risk of your business is going up because you have more stranded assets, your cost of capital is going to go up, and ultimately your access to financing is going to be reduced, and at the extreme, potentially cut off. Right? And if you want an example of that, we only have to look at the coal industry around the world. There are so few buyers of coal assets around the world now because nobody wants to buy a coal asset which is a 40-year asset that they've got to run it for. There were people buying. Now, admittedly, the last couple of years have been slightly different because of the crisis, but that is very much a blip. But pre-crisis, people were buying coal assets around the world on 2.5 year paybacks. Now that sounds brilliant, but the reason is because no one wants to touch it, right? Because you're terrified of buying a stranded asset or being regulated or being litigated against. So I think that's the backdrop. I don't want to talk for too long, but there's a couple of other things I wanted to mention to you in terms of what's coming up, because I think we're all hopefully broadly aware of most of these issues. One of the things I would talk about, and again it was mentioned earlier, was the rise of S. We do get a huge amount of focus on E, and it is undeniably important, but the reason it's been done first is because you can count carbon, right? You can count a molecule of CO2, you can price it, you can buy it, you can sell it. S gets way more difficult when you're talking about education, health, hunger, etc. But these things are really, really coming up the agenda, and there are ways now where the metrics are being produced for those, and we and many other institutions can help with that. Another one, if you're just starting to get your head around the TCFD, the Task Force on Climate-Related Financial Disclosure, which is the one we just heard about, which is being mandated by the G7 and potentially the G20 as well. In September this year, we have the TNFD, the framework for that coming in, which is the Task Force on Nature-Related Financial Disclosure. And there will be a lot of noise this year at COP28 in the UAE in November. Now, if you think it's difficult to count CO2, your emissions, and the risks and opportunities in your business related to climate change, try doing it with nature, because there is no nature equivalent of a molecule of CO2. The issues are very, very different depending on where you are in the world, and you can't price it in the same way. Now, corporates are going to be, as we heard earlier, that's going to be voluntary to start with, but it's a pretty safe bet that ultimately it will go to be mandatory. And even if it doesn't, large institutional investors are going to have to report on what they're doing with the money. So they are going to expect companies to report on that. So if you're not reporting that and you're a large company, that again is going to impact your access to capital. The last thing that I just wanted to make you think about, and if we can pop that presentation up, there's a couple of slides I wanted to talk you through, which hopefully will whet your appetite for the discussion. Is that there might still be some of you that are sitting there that are a little bit unconvinced about this. But one of the other things which has become incredibly important, not just in a business sense, but from an ESG perspective, is supply chain. Now, we're all aware of the issues that are happening globally at the moment because of supply chain disruption, partly because of the Black Sea conflict. Perfect. Thank you so much. But also the hangover from COVID, etc. But it's becoming important because of this shift from a recognition, and I'm not going to talk about sovereigns, don't worry, it's just the slide that I wanted, but it's this recognition that companies are not an island anymore. Now, do we accept, let's take an example, do we accept a T-shirt or clothing retailer now that turns around and it has T-shirts that it finds are being manufactured in a sweatshop somewhere in the world using child labor, do we think it's okay anymore if the company turns around and goes, hey, look, I don't make the T-shirts, I just sell them? We don't, right? We moved on from that a long way away. And this is this concept of corporate responsibility. And this move from what we call scope 1 to scope 3. Now, everybody originally was talking about scope 1 emissions, which is just the emissions that come from what you do in your company. It's the electricity, if you have an industrial process, or the gas that you burn. Scope 2 is the energy that you buy in from somebody else, like your utility. Scope 3 is the one that I mentioned earlier. Now, that is all other indirect emissions, and that includes all the emissions from your entire supply chain. And it also potentially includes all the emissions from the use of your product as well, depending on which industry you're in. And that is a pretty sobering thought if you consider it. So, say for us as a bank, more than 90% of our scope 3 emissions come from what we finance, not from fuel that we buy in and use to heat the buildings or light the buildings, etc. The point I'm trying to make is that financial markets now will not accept anything other than a scope 3 target. They'll accept a scope 1 target, saying we've managed to count that, we ultimately want to move to that, but it's very difficult for us to understand our supply chains. But the point is, ultimately, they want to know that it's going to be scope 3 net zero. Now, that is important to you not just for your supply chain, but it's also important for you as businesses to think, where are you in other people's supply chains? So if you supply, either directly or indirectly, a large company in the world that has got a scope 3 net zero target, that will mean that your business is expected to be net zero as well. Now, to come back to this point about supply chain finance, if you're not and you're holding them back, they're left with two choices. They can either accelerate it in other parts of the business, they can go out, they can buy carbon offsets, or at the extreme, obviously if they buy carbon offsets, that's going to cost them money, which might affect your terms negatively. But at the extreme, they're going to switch suppliers, and they might even pay another supplier more to negate the fact that they've actually got to buy any offsets. So the key point to take here is not to think for any moment that you are operating in a vacuum, because you're all in a business ecosystem. So even if you're not moving at a speed, your suppliers might be, and importantly, your customers will be. So stuff that happens in other countries around the world and in other industries can be hugely significant to the pressure which is being put on you. That was one point I wanted to make. The other point I wanted to make was just about the rise of net zero around the world. Now, this is a great chart that you're not going to be able to see or read at all because it's far too small. But if you look on the left-hand chart, you have essentially got GDP per capita along the bottom. I know you're going to like this one. So you've got richer countries to the right, higher levels of GDP per capita, and on the y-axis you've got energy intensity. Now that's the amount of energy which is used per unit of GDP which is created. So basically, you've got manufacturing companies are higher up, and service companies or service economies which are lower. Now, the green boxes on that chart are all the countries in the world that have issued net zero targets. So what does it tell you? It basically tells you that all the developed countries in the world that have essentially outsourced all of their manufacturing activities and all their carbon-intensive activities have outsourced that to developing economies and emerging markets. But they've put a net zero target on it. You can see the largest net CO2 importers there. So if we work our way along that, what's that? There's USA, Japan, Britain, Italy, France, Germany. So it's all those countries that you might feel are being a little bit holier than thou, putting net zero targets in, but they've effectively outsourced all of those emissions. Now, the reason I wanted to mention that, if you want to see the other side of it, there's your importers up the top. There's your largest CO2 net exporters on the bottom. This data's a little out of date, but it hasn't changed that much. And there you've got China, Russia, South Africa, etc. Easier to see on that map. Essentially, blue countries are carbon exporters, red countries are carbon importers. Now, the reason to mention that is that clearly, no, I'm not going to go through this. This was just to show you that what we've done in one particular report is analysed all of the cross-border carbon in the world by industry and by country. And the reason I mention it is if we are going to go to net zero by 2050, and bear in mind there's 193 countries that have signed up to the Paris Agreement and have said that we do want to try and limit global warming to 1.5 degrees, all of that cross-border carbon is either going to disappear or it is going to be taxed. And that includes on a scope 3 basis, right? So the reason I'm mentioning that is to frankly frighten you a little bit, to think that this isn't just about you, but to say that, all of that is going to disappear. So if you have a carbon intensive product or the materials that you use are carbon intensive or come from a carbon intensive economy, that's either got to disappear or it's got to be taxed. And the biggest issue is this point, which is CBAMs, which is my last point. So the EU is putting in place what's called a CBAM, which is a carbon border adjustment mechanism. And what it says is that in Europe has a price of carbon which is applied to everybody that manufactures there. What it says, if you want to import something into Europe from a country that doesn't have an equivalent price of carbon, they will tax it at the border so that it is effectively the same as if it was manufactured in Europe. Now, it is designed, apparently, to encourage other regions of the world to up their climate ambitions, as well as stopping what they call carbon leakage, which is manufacturing activities from moving to effectively lower cost jurisdictions. So obviously getting a lot of criticism about the fact that it's just protectionism. We're now seeing elements of this in the US with the Inflation Reduction Act, of course, where we're talking about local content rules, etc. So you can expect to see more of this. But this was the last point I wanted to make to you again about not being an island either, in that as you start to see things being taxed as they're moving across borders, it's either going to disappear or it's going to get taxed. And if your business is behind on this stuff, that is going to be very much a headwind against your business. So it's another reason to get ahead of this. It's not just about you. It is about access to capital, and it is about the global business ecosystem around you and what's happening in other industries. Hopefully that has made you think a little bit. I'm happy to go in Q&A anywhere, whether it's financial instruments, whether it's social aspects of ESG, or if it's technical stuff, or you want to talk about cost premiums in sustainable aviation fuel, or whatever it is. So we can jump around pretty much anywhere. But hopefully that's given you food for thought. We do have a huge library covering all of the SDGs and all of the data and library to help you deal with that stuff, and we can also help you with the frameworks as well. So if we can, please do reach out to Noor or to me.
Being a guest, I've listened very well to what you've mentioned, Jason, and really thinking about when His Excellency nudged me if I wanted to say a few things. You've spoiled it for me because you've covered most of the things, but I started taking notes on. But in general, I think what you're interested to hear today is what is the government doing. But it's very important to look at the role of the private sector as well. The private sector plays a key role. And I think if you look at the previous COPs and the recent COP and the upcoming COP, it talks about the trillions of dollars that the private sector will be contributing to. Those $45-50 trillion that were flashed on the board are not the 100 billion that were promised by governments. This is where action really will take place in the private sector. And today we're talking about the ESG, environment, society, and governance. But also we used to speak about CSR. And there's another one called CVC, shared value creation, and that's really the important one. That is the one that makes sense to businesses. If I want to contribute to society and I want to contribute to the sustainability agenda, and I want to also establish governance within my company, and governance is very challenging, especially for family-owned businesses, then what's in it for me? It's good to be a good custodian of the earth, and it's good to be a contributor to solutions. But private business also wants to see what is the benefit. And ESG was established for that. ESG was saying if you do well environmentally, if you do well with society, and you establish proper governance, you will be more attractive for investors. You will be a place where not only investors will feel safer putting their money in, but you will be a place where your employees will be more loyal to you. And where your stakeholders, where your neighborhood will feel better about having you in their neighborhood. So imagine if you're a factory and the excess heat that you're producing in your factory goes towards warming your neighborhood. Or the waste that you're producing goes towards being part in the circular economy through the extended producer responsibility, and in the process employs our youth, pluck them out of dangerous unemployment grounds, and employ them in the green economy, which is the future. Green tech and green economy is the future. Trillions of dollars will go into that area and into that sector of the economy. And in Jordan, as government, ESG is, honestly, it's a corporate thing, and companies should do ESGs. And one day, Jason, I hope that it will be mandatory, but I don't think that will happen. It might be a long, long, long time from now. But at the same time, governments should be enablers for private sector. And when you look at the triple bottom line, there's also public-private partnership, not only people, planet, and profit. So they have to work together. Government and the private sector have to work together. And I came from the private sector, so I understand that very well. I understand that when the government is not an enabler, what a hindrance that will be to your business. But at the same time, I came from the private sector that is well aware of the regulatory framework. And you got to work within that regulatory framework to achieve your goals, not bend the rules, not ask for the laws to be changed. So that's the dialogue that I continually have, where businesses come to me and say, well, you got to change the law. It's not written in stone, but we cannot change the law to be tailor-made for the size of a certain corporation. So it's good to have a full understanding of the regulatory framework in any country and work towards that, because part of your governance as a company is to work within the legal framework of that country, because that puts your investors and stakeholders' minds at ease, hence transparency and accountability. So all of these things work very well together. But as government, what we've done is that we put forward our nationally determined contributions that Your Excellency has mentioned. And we've also put the Green Growth National Action Plan, which is in 6 sectors. It's in energy and water, waste management, agriculture, transportation, and tourism. That one always eludes me. Ecotourism is very important for Jordan. And the national determined contributions is in harmony with that. And then we recently put forward the climate change strategy up until 2050. And those 3 are part and parcel of the economic modernization vision, where sustainable resources, sustainable environment, and quality of life are the 3 of the economic engines moving forward until 2033. So everything is in harmony, regardless of what people think. Some people think is that the government is not working as a well-oiled machine. We actually have taken all of these things into account to make sure that there is no contradictions between them moving forward to another decade, up to 3 decades. So we can't be stumbling over each other's plans. So all of the government ministries are part of these plans. The line ministries, energy, water, and others, agriculture, are all part of that. And at the same time, in these plans, there are real opportunities for the private sector to engage. So the private sector can look at a menu of $8 to $10 billion of projects and say, this is a great project to invest in. It plugs very nicely in my green plans, and I can tick many of the boxes in the sustainable agenda. So it works well together, but it takes some time to sit down, click on that link, read that plan, identify opportunities, come talk to government, and see how we can work together. We work together. We're all citizens of this country, and we have to work together. We are not on different sides of the aisle. It's not government and it's not private sector. It's jointly how we can pull together and make this happen. In the future, and I agree with you, Jason, CBAM was one that I wanted to talk about. Companies who know their carbon footprint, who know their emissions, and know how to reduce them to match markets that they want to export to, will have greater opportunities to export their goods. So it will not be mandated by government, it will be mandated by business. It will be mandated by opportunities. It will be mandated by markets that you would like to access. The more markets that you would like to access, better paying markets that you'd like to access, will require that you respect the environment and watch your greenhouse gas emissions and reduce them significantly so that you can be a better business partner. I've taken too long. Thank you very much. I appreciate it.
I mean, I think first thing to say is to agree with what you're saying. Everybody talks about E and increasingly the S. It's not a tool that G has gone away. I think, and I'm guilty of this myself, is that there's almost an expectation that G has got to be there, right? And it's got to be good. Now that may be ill-founded, but I totally agree with you. You can't, it would be very difficult to have very strong E and S policies if your G isn't sorted. In answer to your question, I mean, are people going to? I think, given that they take it as a given, it's very difficult to see people investing in companies with really bad governance. But having said that, one thing I didn't, one of the many things I didn't talk about today, but is when we were talking about performance of companies, and one of the things that Her Excellency mentioned earlier was about better ESG companies performing better. That ought to be true over the longer term, but does depend on business cycles and many other factors as well. One of the things that has been proven time and time again to be almost incontrovertibly true is that ESG momentum leads to better. So it's a little bit like thinking, I guess the best analogy is if you think about your earnings estimates that are out there in the market, if those are improving and they're improving more than the market recognizes, the stock's likely to do better. Right? And I think the key message to take from this is, and it's maybe something I should have said earlier, is that you don't have to be perfect. No one expects you to be perfect. You could almost argue it's better not, right? Because if you're one of these sort of big businesses out there which is seen as being, amazing on ESG, etc., there's not a hell of a lot of upside. You've got to keep. It's increasingly difficult to keep moving that dial, right? In a sense, all you can do is get it wrong or make a mistake and go down, right? Whereas what investors particularly like to see is, right, they don't want to see, the worst companies in the world, right? But investors love a business where it isn't great. It's honest about how it's not great. Comes back to what I was saying earlier about looking at your business, but it has a plan for how it's going to improve that. You can see how that's going to improve financial results, it's going to improve returns, it's going to reduce risk. So you've got this nirvana of returns going up, cost of capital going down as well. So long answer to simple question. If G is really bad, no. But all of these things, it's about a journey, and it's about taking your stakeholders on that journey with you, explaining where you're trying to get to, what are the milestones along the way, what are the metrics, being honest.
Thank you. Nadia, Adit. One mic.
Thank you for the presentation. It's quite interesting. Actually, I want to zoom in a bit on the financial services industry or banks, since you come from there, and it's good to benefit from your experience and take it one notch down probably in the zoom in the question. Actually, I have 3 questions, if you may, but they might feed into each other. The first one is, like as you said, the trick is that this is so big and so wide, and you need to identify priority and what do you need to do first. But still, from your experience as a banker, what makes most impact? I mean, like, where should you start as a matter of principle? I mean, like in banks, you look at credit, you look at investment, supply chain, you look at your internal operation, the external impact coming from customers, etc. But still, there must be a sweet spot or an efficient spot of where should you start from, really. That's one. The other thing is, the other thing is, that, as you said also, on an organizational level, this is an organization-wide thing. It needs to be adopted across the whole organization, which means that you have to, again, look at it from the leadership, the board, the CEO, and then look at all the different heads. Everyone needs to think this way. So having said that, where would you position it? I mean, like, of course, this changes from one stage of maturity to the other, but still, what's the best approach you found for you to really roll it out very quickly in an efficient manner? And last, also in a country like Jordan, where probably this is still not as mature and as advanced as we would like it to be, what do you do when the market, if you want to be a leader, sometimes this works against you? Because like when you do that, then you're going to stop doing things that other would do, and you would lose an opportunity, and then it's going to affect your pricing in many cases and so on. So how do you balance that? You wanting to be on the lead, yet, achieve your objectives? Thank you.
Thank you. Yes. Great questions. Thank you so much. I mean, I think, speaking from our own journey, right? Much as I said, more than 90% of our emissions are financed emissions. The reality is, you're not going to get much credit if you go out and talk about financed emissions. But actually, when somebody says, "Yeah, but actually, how much energy do you use in your buildings?" and you can't answer it, right? So I think this is why most businesses will inevitably start with scope 1. They will start with they'll start with water usage. They'll look at not easy, but the ones that you control and you have the data for. So I think that's the first thing to say. As you start with that basic stuff, you also learn through that process, right? Because you're going to be dealing with you've got accountants who are going to be dealing with megajoules, kilowatt hours, things that they've never really looked at, right? So it helps with that sort of general conceptual education before you then start moving into that scope 3 side of it. I mean, that is going to get easier, those things. I mean, the challenge for us as a big global bank is that, without getting sort of too technical, is the sort of double count, treble count, quadruple count. So if you say that we're financing a mining company that produces iron ore, which then goes across a border to a company that turns it into steel, which then goes back across another border, which is turned into an auto component, which then goes into Europe, which is turned into a car, which is then sold to somebody in the States, right? It's like we might be financing all of those different companies, and they might all be telling us about certain emissions. But if we add all of it up, we're going to end up counting the emissions from the iron ore separate. It's so that is hugely challenging. But your clients are trying to do that as well. Yeah, I mean, we had one meeting the other week. It's very interesting hearing you talk about SME. And, for a lot of these businesses, people are doing the work on them without realizing they're doing the work themselves. So there's one ingredients company we met the other week who has tracked one ingredient back 300,000 farms. Now, a lot of those farms are 1 or 2 person farms, right? They have no idea that they're being looked at from that perspective, right? So it's tricky, but I think you start with scope 1, and I think you move more broadly. How do you get buy-in across the organization? I mean, that's something I have lived through myself, and I had to do it years ago with our bank, and it was made very clear to me that if I went in, I'm not an evangelical tree hugger, but it was made very clear to me that if I went in as an evangelical tree hugger, this was not going to work. What I did was showed, and we were talking to an important client about this very morning, but I had some charts which showed them two industries. One was the renewable energy industry, another one was the electric vehicle industry. And essentially what we showed the bank was we talked about where this was going. And we got the inevitable comments about, yeah, but electric vehicles are nowhere, or renewables is a tiny part of the mix. And then what we did was we started with the charts of adoption of renewables and percentage of fleet, and the same with electric vehicles. And then we showed them when the capital expenditure. Think about what a bank does. A banker raises capital, right? So they're not particularly interested in which cars are getting sold. They're interested in the companies raising the capital or managing the working capital. Once they saw that actually, although they had the perception this thing was tiny, but all of the capital investment flipped over to new stuff, that was when the penny dropped. This was not, this was not a nice thing. This was about real money. And then the last one was leading versus right. So I think it's a challenge, right? I think that one of the advantages of showing leadership is that you get to shape the debate. And certainly being one of the laggards, you're going to end up getting told where to go and being regulated arguably out of existence. Plus, you're going to have a more expensive cost of capital. Yeah. You're probably going to lose clients, etc. I mean, I do think that we're always going to get these sort of sin sectors where bits of the global economy that are finding out. So coal, tobacco, hey, they know those people in school provide that gap. Often they set up. So some people will stay in that world. I think today that's the advantage of leader. The key point I would make, and I don't think we should hear this as a cult, because I think doing it right, the idea is there might be a short investment for this happened. So I think I would rather be a leader, but also I wouldn't necessarily be too strict about what we tend to do is, rather than being very didactic about what we're going to lend to this kind of stuff, is say that beyond that we won't lend by that stage. And then you have to help your clients transition. So you can be a leader, but not turn that tap off, but help them transition, signal where you go. So clear signaling.